a week, Trump's tariffs and relief whipsaw the world's markets. Investors are now reallocating investments to economies considered relatively insulated. So that includes us. Our next guest says, anecdotally, companies from North Asia are looking to the Philippines as an alternative destination. Joining me now from Makati is Jonathan Koh, Singapore-based Standard Chartered Bank economist and foreign exchange analyst. So good to see you, Jonathan. Thank you so much for making the time.
Thanks, Katie. Thanks for inviting me here. It's a pleasure.
Yes, I know that you've been speaking at an industry summit there and have had a few client meetings on the side. What's the overriding mood, if you will? Just speaking with those in the business and investment community here, what is their sense of the Philippines' degree of exposure to Trump 2.0?
Sure. So I think the sense for the Philippines itself, especially that I've done meetings around the region as well, is I would say it's one of cautious optimism, and mainly because with regards to Trump 2.0, the Philippines economy is a lot more domestically driven, so it's a lot more insulated. 75% of the Philippines economy is driven by domestic consumption or domestic demand, versus, for example, the likes of Singapore, where more than 60% is driven by external demand. So I would say it's more of cautious optimism at the moment.
Yeah, it's a good phrase, cautious optimism amid the whipsaw that we've seen in global markets. You were quoted by Business World earlier saying, anecdotally, that what you are seeing and hearing is that a lot of companies from Korea and Taiwan actually are looking at the Philippines as an alternative destination. But what exactly do they like about the Philippines?
Sure. So I think ultimately, when you invest in ASEAN as a region, or Philippines as a region, I think firstly, in terms of Philippines being targeted in terms of bilateral tariffs, we think that is very unlikely. And the reason for that is the Philippines only runs about a $4 billion trade surplus with the US. So from a revenue perspective, I mean, US imports from the Philippines is not even that much. So we don't really expect Philippines to be on the radar of the Trump administration. Secondly, I think investing in the Philippines, you have a high quality of labor, and the population is mostly English speaking. So and you also have a very young working age population. So very clearly, I think those are the demographics that actually work in the advantage of the Philippines as well.
That's demographics and the relative insulation from what's going on overseas. But to what extent is that relative confidence showing up in the markets? We've seen local stocks up 4 straight days, though still below 6,200, yields at 1-month highs when you look at the 10-year Treasury. And the peso has been relatively stronger versus the dollar in the 57 level.
Sure. So I guess in terms of FX, how we are looking at it is, in terms of the dollar, or rather in terms of Asia FX, there are a few crosswinds. So we basically look at it in 3 ways. I think first is basically the Trump trade, second is the Fed trade, and lastly is the CNY trade. Now, in terms of the Trump trade, it's really in terms of thinking about it in terms of potential negative US policies being inflation-inducing, or potential higher fiscal spending from the US being fiscal-inducing, resulting in the Fed having to keep tighter monetary policy and higher interest rates, and therefore being a stronger dollar. Now, from that perspective, if let's say the dollar strengthens, currencies which basically have a high beta to the dollar will actually do worse, or depreciate more against the US dollar relative to other currencies in the region. Now, the second is the Fed trade, and it's basically what markets are pricing in terms of Fed cuts. And at the moment, markets are pricing in about 3 Fed cuts. I mean, we are calling for just 2 at 50 basis points. But I would say 50 to 75 basis points of pricing in terms of Fed cuts is probably quite fair. And the lastly is in terms of the CNY trade. And China has basically been keeping CNY relatively stable. And usually, again, if let's say CNY depreciates, then it's going to be the currencies that have the high beta to CNY that are going to depreciate. So in terms of how things have played out so far this year, I would say that because the Trump trade hasn't really played off in terms of, I think you were just mentioning earlier, Trump basically walking back on some of the tariffs under the US for goods under USMCA. So very clearly the dollar has kind of weakened, and so that has in a way helped Asian currencies. But the low yielders, those more externally exposed, that actually weakened a lot more in Q4 last year, actually outperformed.
Just as a final point, we got 15 seconds to go. Where do you see the peso trading in the next 3 to 6 months?
Sure. So I'm currently looking at about 57 to 59. A lot of it is going to depend on the dollar.
All right. Well, thank you so much, Jonathan Koh of Standard Chartered. Safe travels next to Cebu. Appreciate the time.